Welcome to vTalkInsight, Risk Sentiment Daily for December 17th, 2025. We come into today with markets caught between an AI-powered growth story and increasingly late-cycle risks, as softening labor data, rich valuations, and fiscal concerns pull against still easy policy and strong liquidity. Risk sentiment today looks late-cycle and two-way rather than cleanly risk-on or risk-off. Medium-term optimism around growth, policy easing, and AI remains intact, but near-term caution is building as labor data softens and valuations stretch. Recent equity moves have been modestly negative and volatility is back in the mid-teens, consistent with a market that is still willing to hold risk but increasingly sensitive to macro surprises. On the constructive side, the macro narrative remains anchored by strong supply-side dynamics. Productivity growth is expected to stay robust, potentially above 2% next year, and that underpins forecasts for real GDP in the 3 to 3.5% range, well above consensus. AI adoption is already driving measurable productivity and wage gains for trained workers, while U.S. capital spending has jumped more than 10% after recent legislation and is expected to be reinforced by an AI-led capex boom. Against that, the labor backdrop is looking more fragile. The latest payrolls report showed only 64,000 jobs added, unemployment has risen to 4.6%, and the three-month average of job gains is down near 22,000, all pointing to a cooling jobs market. At the same time, consumer signals are mixed, with weaker holiday spending and card data contrasting with earlier strength in core retail sales and real incomes, leaving investors unsure how durable the consumption pillar really is. Positioning and event risk amplify that late-cycle feel. Equity valuations are elevated. Cash allocations among fund managers have dropped to record lows around 3.3%, and optimism for 2026 is unusually high, all of which leave less buffer if the data disappoint. Upcoming labor prints are also unusually noisy, with the statistics agency flagging higher error bands, so even modest surprises could trigger outsized moves in rates and equities. Taken together, the tape feels balanced but fragile, with investors leaning into the growth story while keeping one eye firmly on labor, inflation, and yields. One of the strongest bullish forces is the AI-led productivity and growth boom. Supply-side indicators such as capital stock, labor growth, and productivity point to U.S. GDP potentially exceeding 4% next year, with AI adoption a central driver of that upside. Productivity growth itself is expected to remain above 2%, boosting real incomes as wage gains outpace inflation and helping to sustain consumption even as job growth cools. Evidence of this AI-driven cycle is broadening across corporate and real economy signals. Recent U.S. capital spending surged more than 10% after a major policy bill, and optimism is high that AI-enabled productivity will further lift growth next year. AI-focused platforms such as Databricks are posting around $5 billion in revenue at roughly 55% annual growth, while Amazon Web Services is expected to accelerate its growth rate, both reinforcing the idea that AI demand is still in the early innings. This growth engine has important market implications. It supports earnings expectations not just for big tech, but also for industrials, infrastructure, and manufacturing-oriented real estate that enable data centers and supply chains, and it underpins constructive views on base metals like copper and aluminum. There are constraints, though. Energy supply is already limiting the pace of AI infrastructure build-out. AI-related power demand is set to dominate incremental electricity use this decade, and projected capital expenditure by hyperscalers into 2030 assumes unprecedented revenue capture. That means AI is both a powerful source of upside and a potential locus of execution and capacity risk that investors will need to track closely. The second key support for risk assets is accommodative policy and abundant liquidity. Despite a cautious tone from the Federal Reserve, several officials argue current policy is too restrictive, and there is a strong case that rates are higher than needed given supply-side driven growth. Markets may even be underpricing the odds of additional rate cuts in 2026 as unemployment rises and inflation moderates, suggesting that the easing cycle could run further than current consensus implies. Beyond the policy rate, liquidity remains supportive. The Fed is continuing asset purchases that, while not branded as quantitative easing, are adding liquidity and were part of the positive market reaction to the latest meeting. Liquidity conditions are now rated as the most positive since 2021. ETF launches, inflows, and trading volumes have all hit records, and options markets show investors still comfortable selling volatility, all consistent with a backdrop that encourages risk-taking. Globally, there are further signs of accommodation, with the European Central Bank expected to lean more dovish if data continue to soften, and several other central banks already cutting rates. A weaker U.S. dollar profile tied to this easing bias also supports risk-sensitive currencies and non-U.S. assets. Still, this policy cushion is not without risk. Simultaneous monetary and fiscal stimulus outside a recession is historically unusual, and if inflation proves stickier than expected, the current comfort around liquidity and easing could give way quickly to concerns about policy mistakes and renewed volatility. A third constructive driver is the broadening equity rally and deal flow. After a long stretch of mega-cap dominance, market breadth has improved meaningfully, with around 61% of S&P 500 constituents outperforming the index over the past month, compared with only 17% over the previous 6 months. There has also been a notable rotation into equal-weighted indices and sectors such as industrials and utilities, suggesting that leadership is slowly widening beyond the narrow group of large-cap tech names. Cyclical value sectors including financials, industrials, and materials are expected to provide both stability and potential upside into 2025, helped by a steepening curve and strong capex incentives. In parallel, commercial real estate and manufacturing-oriented real assets are attracting capital, with prime offices achieving record rents and logistics, and advanced manufacturing facilities benefiting from trillions in public and private investment. Capital markets activity reinforces this broadening tone. Global M&A volumes are up roughly 40% to about $4.5 trillion. Megadeals are taking a larger share of activity, and the IPO pipeline is reopening, with the Medline listing expected to be the largest of 2025 and potential high-profile tech and AI names lining up for 2026. That said, rich valuations and concentrated positioning mean this rotation is not bulletproof. If growth or rates surprise negatively, the shift into cyclicals, real assets, and deal-driven stories could stall, leaving investors reevaluating how much of the earnings and synergy story has already been priced in. On the bearish side, a cooling labor market and noisy data are becoming central to the risk narrative. Recent reports show U.S. job growth slowing to its weakest pace since early 2021, with employment up only about 6% over the past year and the latest payroll gain a modest 64,000. The unemployment rate has moved up to 4.6%, the highest since mid-2021, and underlying analysis suggests true break-even job growth may be near 40,000, leaving little margin before the labor market starts to deteriorate more visibly. Complicating matters, the data themselves are less reliable than usual. The statistical agency has warned of higher variance and technical issues in the unemployment figures, including seasonal adjustments, and government payrolls are likely distorted by recent shutdown dynamics. As a result, private payrolls are seen as the cleaner read, but even there, expectations are for continued cooling in October and November, with little chance of a strong upside surprise, which keeps markets on edge around each release. For markets, this mix creates asymmetric event risk. Options pricing ahead of labor data suggests investors are assuming limited impact on the Fed narrative, yet if job growth were to fall meaningfully below break-even or unemployment were to jump again, it could rapidly revive recession worries and lift volatility from unusually low levels. At the policy level, further weakness would strengthen the case for a more dovish Fed stance, But that same weakness would also challenge the optimistic earnings and growth assumptions currently embedded in risk assets, setting up a more binary reaction to each incremental data point. The second major headwind is elevated valuations and crowded positioning. The S&P 500 is trading around 23 times next year's earnings, a multiple last seen in the early 2000s, even as growth expectations remain optimistic and policy is already easing. At the same time, consensus still projects 10 to 12% upside for U.S. equities into 2026, implying relatively little room for disappointment on either earnings or rates before multiples and expectations collide. Positioning indicators echo that message. Global fund manager cash allocations have dropped to record lows near 3.3%, historically associated with negative 4-week equity returns, and surveys show risk appetite heavily skewed toward equities and away from bonds, with the largest fixed income underweight since late 2022. Market optimism is also highly concentrated in a handful of large-cap U.S. stocks that now make up roughly two-thirds of market capitalization, raising concentration and tracking error risks if earnings growth fails to broaden further. This combination leaves markets vulnerable to even modest shocks. Recent de-risking in Bitcoin and crypto, where prices have reversed earlier gains and leverage has been flushed from derivatives markets, illustrates how quickly sentiment can turn when positioning is stretched. Technology and AI-related equities, while not necessarily in a classic bubble, are expensive and have previously seen large drawdowns without any obvious trigger. With hedging relatively cheap and long-dated protections still light, the risk is that a negative surprise on growth, labor, or policy could produce an outsized reaction as investors rush to rebuild buffers. The third bearish driver is inflation and fiscal-driven yield risks. While one camp expects core inflation to drift back toward 2% next year thanks to softer goods prices and easing housing costs, another sees persistent pressures that could limit how far the Fed can cut. Surveys from the Atlanta Fed indicate firms still intend to raise prices through 2026, and ongoing tariffs and coming fiscal measures, such as higher refunds and depreciation incentives, risk adding to demand and price pressures rather than easing them. Fiscal dynamics are increasingly in focus. U.S. fiscal sustainability is flagged as a major macro risk into 2026, and concerns about rising debt and issuance are feeding into higher term premia, particularly at the long end of the Treasury curve. Even with expectations for an accommodative policy backdrop, 30-year yields remain elevated around the mid-4% area and have at times approached 5%. Offsetting some of the easing in financial conditions from lower front-end rates. Base case expectations still call for bull steepening, with short-dated yields falling while the long end holds roughly steady, but both policy or fiscal shocks could easily disrupt that path. Large asset managers are already shifting underweight long-duration treasuries on these concerns, and if inflation surprises to the upside or fiscal worries intensify, higher real yields could pressure equity valuations, tighten financial conditions, and challenge the assumption that funding costs will stay benign for leveraged business models over the next few years. Stepping back, today's picture is one of a late-cycle, two-way market where an AI-powered productivity story, policy easing, and broadening equity participation are pulling in one direction, while labor softness, stretched valuations, and fiscal and inflation risks pull in the other. The balance of these forces suggests that outcomes are likely to be increasingly data-dependent, with labor prints, inflation expectations, and long-end yields acting as key catalysts for shifts in risk sentiment. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.